property market and the signals within the property market have long been viewed as one of the strongest indicators of economic confidence. And today is 15th of July 2026. I am going to go through what I'm seeing as the property signals, how that's going to affect you as an investor, and what are the implications further down the line. So, welcome. Bonjour, hola, ni hao. My name is Karen Newton. I am a business and wealth strategist. And what that means is that I look at things that are happening in the news around the globe, and I pull what seem like random stories together, and I find the underlying pattern that exists within them. And this week, those signals are looking at property. So what are the key points that I've noticed over the past couple of weeks? Well, the first one is in the UK, and that's where we've got the UK builders who are now discounting properties because their sales have slowed to such a level that it is the only way for them to move their stock on. And if they can't move their stock on, they can't get ready for other developments. It ties a lot of capital, money, etc. up. So UK builders are one of our first indicators. They are starting to discount properties. Now, the second one in the UK market is estate agents, because what's happening with the estate agents is that they have said prices are starting to come down, but sellers are still wanting yesterday's prices. They are reluctant to drop the price. And that means that instead of properties turning over at a reasonable pace, the whole property economy is starting to slow down. And naturally, those prices will drop until they get to a level where buyers want to come in. Now, the third thing that I've seen in the UK property market is what's called activist investors. Now, these are big companies. They have a lot of money. They are buying REITs. REITs are real estate investment trusts. They are listed on the stock exchange. And they are seeing a lot of opportunities coming with REITs now to be able to get in to the property market in the UK. Now, activist investors are not going to go through and pay premium dollar, premium pound, whatever your currency, to access these properties. They are going to be looking at lower valued properties and lower stock prices that allow them to come into the market. So we're already seeing 3 different indicators that are suggesting the UK property market is going to turn and head towards that downward trend. Now, I don't have a crystal ball. I can't say it's going to happen next week. I can't say that it will be 10 weeks from now. I don't have that ability to do that. I don't have any data to be able to analyze it. But for investors like you and me, when we see these indicators, it's a warning that either we position our properties, our property portfolios in a certain way to protect them, things like reducing mortgages, making sure that we have good margins within loan to value on the mortgage to the property, good cash flow as well. So we're looking at protecting, going quite defensive with the property portfolio. Now, it's not just the UK market, we have this global market, and we're seeing the signs globally. First of all, if you follow my blogs are karennewton.co.uk/blogs. You'll see that quite some time ago, a couple of years ago, I started writing about Evergrande, which at the time was a huge Chinese property company. That company got into trouble, and we see some of the ripple effect, and the ripple is important when we're looking at where we think things are going to go. We're looking at this ripple effect that came out of China. It's flowing slowly through other markets, but China has found itself in a difficult situation. They have now had 35 consecutive months of, I'm going to highlight this, correction. Okay, I put that in inverted commas. Basically, the property prices are still dropping. The Chinese government are trying different things to prop the property up, but those property prices for 35 consecutive months are still dropping. Now, what that indicates is confidence, total lack of confidence in the Chinese property market. If you are someone who invests in China, then the property market's quite worthwhile looking at the moment, because who knows? That might be the last time the property prices drop. They may continue to drop. But we can see 35 months, that is a long time for a property market to be dropping, especially when the government are using all types of incentives, just about everything that it's got in its weaponry, to stabilize those prices, and then be able to bring the prices up slightly. We always like a little bit of growth, usually in line with inflation. So China is trying at the moment to put that stopgap in, that plug in the hole, if you like, to try and stabilize what is happening in the property market. Europe-wise, we have a mixed bag around Europe. I live in Spain, and property prices have been growing pretty steadily here. There's been a huge investment into the property prices, although that is starting to slow. Now, when we see some of the names, and they are billionaires who run companies who are coming in and buying property in Spain for investment, we still see that although the property market has been growing in Spain, there are still huge opportunities. Now, with the US, we are looking at more regional. Right? We've seen some places where people have exited in large numbers. They've got out of that region, and we're watching property prices go down. But they are going to other regions where you're seeing property prices go up. So we've got a mixed bag around the US. Now, if you follow any of the feedback market news reports that I do, you'll know that I tend to look at four economies. UK, because I am British, large part of my audience is British, so I talk British economy. We look at the US, we look at China, and we look at Europe. And basically what happens is, based on the US, that tends to filter out to other regions. China, because of this global market, we have to watch the bond markets and see what's happening with money flow through China. UK is still, it's a high finance industry. It's one of the biggest in the world. And when we see ripple effects from things like the property market, this is an indicator of a broader area of finance and what could be happening within that market. Now, one of the common threads that we are seeing at the moment is this absolute sucker punch to confidence. We had the pandemic, we saw property prices go up, and then it started to slow. And people are reluctant to accept that property market is slowing down. So when we look at these indicators that are out there at the moment, you know, the ripple effect on property from these four major economies that I tend to monitor, it's all pointing towards property prices dropping. Like I said, I don't know if it's tomorrow, I don't know if it's a month from now, but that ripple effect is starting to get bigger and bigger. And when we look at all these different headlines around the world, we can see that it's a global impact that's going to happen. And that means that you need to get defensive with your investment strategy, particularly with your property strategy. And when I talk about being defensive, like I said, mortgages, if you've got a mortgage on a property at the moment, then make sure you have big margins between the value of the property and the loan to value borrowing in your mortgage contract. When you are a homeowner, governments tend to protect you as an owner occupier of a property. When you are a buy-to-let investor, a landlord, then your property portfolio tends to be one of the first that gets hit. And the only way you can protect yourself is to make sure that you keep well within those loan-to-value property margins. I've noticed a trend that when we have a shallow recession, then property prices tend to drop around 25%. When it is a deeper recession, the property prices tend to drop up to 50%. Okay, so if we're looking at a 50% drop, and assuming this is going to be the worst case scenario, then you need to make sure that that loan to value mortgage can cope and still stay within the right margins if the property value drops 50%. Okay, so that's where you get defensive. Now, I'm not saying don't buy property, because there are lots of property deals out there, but there are alternative ways that you can get property deals, and you can get onto the property ladder. And if you want to learn more about those, then my Zero to Millionaire membership is where I teach the practicalities of investing. So, taking random news, looking at things until I can find a pattern, and then looking at what the ripple effect is likely to be. If you want more of that information, then please check out my podcast, check out my YouTube channel, and check out my blog on karennewton.co.uk. Thank you for listening, and I'll be back with some more information again soon.
Disclaimer. The information shared in this podcast is for educational and informational purposes only. It is not intended as financial, investment, legal, or tax advice and should not be construed as such. I am not a licensed financial advisor, and the strategies discussed are based on personal experience and general market knowledge. Always do your own research and consider your individual financial goals, risk tolerance, and personal circumstances before making any investment decisions. I strongly recommend that you consult with a qualified financial advisor or licensed professional before acting on any information discussed in this podcast. Investing involves risk, and past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated entities are not responsible for any losses or damages arising from the use of this content.